Hi, everyone. Welcome to this week's market update. I'm here with Eric Anderson. Eric, only a few days ago, markets seemed convinced that the Middle East crisis was fading into the background. Oil prices were falling, inflation fears were easing, and investors appeared quite relaxed. But today, that confidence seems to have been challenged. What's changed?
I think the market has been reminded that geopolitical risk rarely disappears overnight. Earlier this week, investors were celebrating what looked like a best-case outcome. Shipping through the Strait of Hormuz had resumed, oil prices had fallen, and markets quickly concluded that the inflation threat was fading. Then we saw reports that an Iranian attack had targeted a cargo vessel near Oman. Now, the ship continued its journey, and oil only rose modestly before settling back, so this wasn't another major supply shock. But I think investors may be focusing on the wrong number. The issue isn't whether oil rises $2 today. The issue is that the world's most important energy corridor has become unreliable again. That uncertainty has consequences that extend well beyond the oil price itself.
So you're saying investors shouldn't just watch Brent crude?
Exactly. Oil is only one part of the story. If shipping companies become nervous, insurance costs rise, freight rates increase, inventory levels have to rise, working capital requirements increase, liquefied natural gas, fertilizers, refined fuels, all of these supply chains become a little more expensive. You don't necessarily need $100 oil to create inflationary pressure. Sometimes uncertainty itself becomes inflationary, and I think that's something markets have perhaps underestimated this week.
That obviously feeds directly into the Federal Reserve. Everyone seems to be waiting for rate cuts, yet they never quite arrive.
That's becoming the central question. The latest U.S. data really didn't give the Fed permission to ease. Growth is still holding up. Corporate earnings remain relatively resilient. Inflation has moderated, but not enough to declare victory. And now we're adding renewed energy uncertainty back into the equation. The Fed doesn't actually need to raise interest rates to disappoint investors. It simply needs to wait. Markets are still priced for lower rates over time. If the Fed remains patient for longer than investors expect, today's equity valuations start looking much more demanding.
Bond markets have actually been fairly calm, though.
They have. Treasury yields eased slightly this week as inflation data broadly met expectations. But I'd be careful reading too much into 1 or 2 days of bond moves. If energy uncertainty becomes a recurring feature rather than a temporary event, those lower yields could easily be tested. Bond investors are effectively asking one question: will inflation expectations stay anchored? That's far more important than whether this month's inflation number is 1/10 higher or lower.
Let's move to technology because there were some very interesting earnings this week. Micron delivered impressive numbers, yet technology stocks still struggled. That feels contradictory.
It's actually one of the most important messages of the week. Demand for AI infrastructure remains incredibly strong. Micron demonstrated that. Qualcomm continues to talk positively about AI investment. Companies are still building data centers. They're still buying chips. None of that has changed. What has changed is investor expectations. Earlier this year, almost any company mentioning artificial intelligence enjoyed a higher valuation. Today, investors are asking much tougher questions. Can you actually generate profits? Can margins expand? Can you execute consistently? The market is moving from rewarding the AI story to rewarding AI execution, and I actually think that's a healthy development. So the AI boom isn't ending, it's becoming more selective. Exactly. We're moving from enthusiasm to discrimination. That usually creates more winners and more losers. Companies that genuinely convert AI demand into earnings should continue performing well. Those relying purely on excitement or future promises may find investors becoming much less patient. Let's turn to Asia because the picture there has also become more complicated. It has. Japan remains fascinating. The Bank of Japan has been normalizing policy, yet the yen remains extraordinarily weak. That tells us U.S. interest rates continue to dominate global capital flows. In China, policymakers are taking a much more targeted approach. They're focusing on improving liquidity rather than launching another huge stimulus program. Meanwhile, India finds itself in an uncomfortable position. Lower oil prices had been helping both inflation and the current account. If geopolitical tensions push energy prices back up, those gains quickly begin to disappear. So Asia isn't one single story anymore. Each market is reacting very differently.
And what about emerging markets more broadly?
The dividing line increasingly comes down to energy. Countries that export commodities obviously benefit from higher prices. Importers become more vulnerable. At the same time, the US dollar remains remarkably resilient. The United States still offers the combination of relatively high yields, deep liquidity, and greater insulation from imported energy shocks. That makes life more difficult for emerging market currencies. Rather than moving together, we're starting to see much greater differentiation.
Finally, Eric, what's your biggest takeaway for investors this week?
I think it's this. Markets spent much of the past week pricing peace. They priced lower oil, lower inflation, lower interest rates, a smoother path ahead. This week has reminded us that none of those assumptions are guaranteed. Geopolitical risk hasn't disappeared. The Federal Reserve hasn't suddenly become dovish. Technology hasn't become cheaper. Private markets aren't becoming more liquid. None of these developments are individually alarming, but together they tell us something important. We're entering a market where investors can no longer rely on one simple narrative. Selectivity matters more, quality matters more, and perhaps most importantly, patience matters more. Because while the headlines continue changing every day, the underlying investment environment remains far more complex than recent market optimism might suggest.
That's it for this week. Stay tuned for more insights next time.